Welcome to TradingView, your trading playground. TradingView is a powerful tool for traders. It's like a playground for anyone who wants to learn about the markets. You can look at charts for stocks, crypto, and forex. It gives you all the tools you need to study price movements. The best part for new traders is that much of it is free. You don't need to spend any money to start learning and practicing. This makes it the perfect place to begin your trading journey. It helps you see the market in a visual way, which is much easier than looking at a list of numbers. Think of it as your window into the world of financial markets, accessible right from your computer or phone. For a new trader, the world of trading can seem very confusing. There are so many charts, numbers, and opinions. TradingView helps to simplify this complexity. It organizes everything in one place. You can draw lines on charts, add indicators, and test your ideas without risking any real money. This is a huge advantage. In the past, traders needed expensive software and data feeds. Now, TradingView gives you professional-level tools for free. It lets you learn at your own pace in a safe environment. You can explore different markets and see how they behave without feeling overwhelmed by the pressure of real trading. The platform is designed to be user-friendly. You don't need to be a computer expert to use it. Everything is laid out in a way that makes sense. You can easily find the chart for a company like Apple or a cryptocurrency like Bitcoin. Once you have the chart, you can change the time frame. You can look at what the price did today, this week, or even over the last 10 years. This ability to zoom in and out of time is crucial for understanding the bigger picture. It helps you see long-term trends and short-term patterns, which are the foundation of building a trading plan. One of the most valuable features for a beginner is the community. TradingView is not just a charting platform, it's also a social network for traders. You can see what other traders are thinking. You can read their analysis and see the charts they have published. This can give you new ideas and help you learn from people who have more experience. You can ask questions and get feedback. However, it's important to remember to think for yourself. Use the ideas of others as inspiration, but always do your own research and testing before you ever risk your own capital on a trade. Let's start with the basics. The most important tool in TradingView is the chart. A price chart shows you the history of an asset's price over a period of time. The most common type is the candlestick chart. Each candle tells a story. It shows you the opening price, the closing price, the highest price, and the lowest price for a specific time period, like 1 day or 1 hour. A green candle usually means the price closed higher than it opened, which is bullish. A red candle means the price closed lower than it opened, which is bearish. Learning to read these candles is the first step to understanding market sentiment. Next, we have chart patterns. These are shapes that appear on the chart over and over again across different markets and time frames. These patterns can sometimes give you a clue about where the price might go next. For example, a double top looks like the letter M. It can signal that the price might be ready to go down. A head and shoulders is another popular bearish pattern. On the other hand, patterns like a cup and handle or an inverse head and shoulders can signal that the price might be ready to go up. Recognizing these patterns takes practice, but they are a key part of technical analysis. Then there are indicators. Indicators are mathematical calculations based on a stock's price or volume. They are drawn as lines or overlays on your price chart. Their goal is to help you understand the market's momentum, trend, and volatility. You have probably heard of some of them, like the moving average or the relative strength index. A moving average smooths out price data to show you the direction of the trend. The RSI helps you see if a stock is overbought or oversold. There are hundreds of indicators available on TradingView, but you only need to learn a few to get started. Think of charts, patterns, and indicators as the building blocks of your trading strategy. The chart is your canvas. The patterns are the shapes you see in the clouds. The indicators are your instruments, like a compass or a speedometer. You don't need to use all of them at once. In fact, using too many indicators can be confusing. This is called analysis paralysis. The goal is to choose a few simple tools that you understand well. You will use these tools to create clear rules for when to enter and exit your trades, which is the foundation of a solid trading plan. So what exactly is a trading strategy? A trading strategy is simply a set of rules that you create to guide your trading decisions. It tells you exactly when to buy, when to sell, and how to manage your risk. It is your personal rulebook for navigating the markets. Having a strategy is what separates disciplined trading from gambling. When you gamble, you are just hoping to get lucky. When you trade with a strategy, you are using a plan that is based on logic and has been tested. You are making decisions based on specific signals from the market, not on fear or greed. Your strategy needs to have clear entry and exit rules. An entry rule tells you precisely what needs to happen on the chart for you to buy or go long. For example, your rule might be, I will buy when the price closes above the 50-day moving average. This is a specific measurable event. There is no room for emotion or guesswork. You either see the signal or you don't. If you see it, you take the trade. If you don't, you wait patiently. This discipline is the key to long-term success. It keeps you from jumping into trades just because you are bored or feel like you are missing out. Exit rules are just as important, if not more so. An exit rule tells you when to sell your position. You need rules for two types of exits, taking profits and cutting losses. A profit-taking rule might be, I will sell when the price has gone up by 10%. A loss-cutting rule, also known as a stop loss, might be, I will sell if the price drops 5% below my entry price. These rules remove the emotional struggle of deciding when to get out. Without them, you might hold on to a losing trade for too long, hoping it will turn around, or sell a winning trade too early out of fear. Why does this matter so much? Because the market is designed to trigger your emotions. Fear and greed are powerful forces that cause most new traders to lose money. A well-defined strategy acts as your shield against these emotions. It forces you to be objective and consistent. When you have a bad trade, and you will have them, you can look back at your rules. Did you follow them? If yes, then it was just a part of the game. If no, then you know what you need to fix. A strategy turns trading into a business-like process, not an emotional roller coaster. Let's build a simple strategy together, step by step. The first part of any strategy is the entry signal. This is the combination of events that tells you it's time to consider buying. We want to keep it simple, so we will use just a few common tools. We will combine a candlestick pattern with a trend indicator and a momentum indicator. This way, we have multiple reasons to believe the trade has a good chance of working out. Using more than one signal for confirmation is a good habit. It helps filter out weak or false signals, improving the quality of your trades. First, we need to identify the overall trend. It's often said that the trend is your friend. Trading in the direction of the main trend increases your odds of success. A very simple way to see the trend is with a moving average. Let's use the 50-day simple moving average. When the price is trading above the 50-day SMA, we can say the trend is generally up. So our first rule will be, only look for buy signals when the price is above the 50-day SMA. This single rule keeps us from trying to buy when the market is in a strong downtrend. Next, we need a specific trigger for our entry. Let's use a bullish candlestick pattern. A great one for beginners to learn is the bullish engulfing pattern. This pattern occurs when a small red candle is followed by a larger green candle that completely engulfs the body of the previous red candle. It suggests that buyers have suddenly stepped in with force and overpowered the sellers. So, our second rule is, look for a bullish engulfing pattern to form. This gives us a precise moment in time to focus on. It's a clear visual signal that buying pressure is increasing. Finally, let's add one more confirmation tool. The Relative Strength Index. The RSI is a momentum indicator that moves between 0 and 100. It helps us see if an asset is overbought, typically above 70, or oversold, typically below 30. We don't want to buy when the stock is already very overbought, as it might be due for a pullback. So our third rule will be, at the time of the bullish engulfing pattern, the RSI must be below 70. This helps us avoid chasing a stock that has already moved up too far too fast. It adds a layer of safety to our entry. Once you are in a trade, the work is not over. You need a clear plan for how you will get out. Many new traders focus all their energy on finding the perfect entry, but they forget that profits are only realized when you exit the trade. Your exit rules are what determine your final profit or loss. Just like with entries, exit rules must be defined before you enter the trade. This prevents you from making emotional decisions in the heat of the moment, when your money is on the line. You need a plan for taking profits and a plan for cutting losses. Let's start with the happy scenario, taking profits. When do you sell to lock in your gains? There are many ways to do this. One simple method is to use a fixed profit target. For example, you could decide to sell after the price has risen by a certain percentage, like 10% or 15%. Another popular method is to use a risk-reward ratio. If you are risking 5% on the trade, we'll cover this with the stop loss. You might aim for a reward that is 2 or 3 times bigger. So, you would sell when your profit reaches 10% or 15%. This ensures your winning trades are significantly larger than your losing trades. Another way to take profits is to use a trailing stop. This method lets you ride a winning trend for as long as possible. For example, you could decide to sell if the price closes below a shorter-term moving average, like the 10-day moving average. As long as the price stays above that line, you stay in the trade. This allows you to capture a much larger profit if the stock goes on a long run. The downside is that you might give back some of your open profits before the signal tells you to sell. There is no perfect method. You have to choose one that fits your personality. For our sample strategy, let's set a clear profit-taking rule. We will use the RSI indicator again. We entered when the RSI was below 70. A logical exit rule would be to sell when the momentum shows signs of being exhausted. So our profit-taking rule will be sell the position when the RSI crosses above 70. This signals that the stock might be becoming overbought and could be due for a pullback. This rule gives us a specific, non-emotional signal to close our trade and take our profits off the table. Section 6. Don't forget the stop loss, your safety net. This might be the most important section in this entire essay. Every single trade you ever make must have a stop loss. A stop loss is a predetermined price at which you will sell your position to cut your losses. It is your safety net. It protects you from catastrophic losses. No matter how good a strategy seems, some trades will go against you. That is a fact of trading. Your job is not to avoid losses, but to make sure those losses are small and manageable. A stop loss does exactly that. It takes the emotion out of losing. Imagine you buy a stock at $100, expecting it to go up, but instead, bad news comes out and it starts to fall. It drops to $95. You think it will come back. Then it drops to $90. You think, I'll just wait a little longer. Before you know it, the stock is at $70 and you have lost 30% of your capital on one trade. This is how accounts are blown up. If you had set a stop loss at $95 from the beginning, you would have been out of the trade with a small manageable 5% loss. You would have preserved your capital to trade another day. Setting a stop loss is not a sign of weakness. It is a sign of professionalism. It is an admission that you cannot predict the future with 100% certainty. Your stop loss should be placed at a logical level. You don't want to place it so close to your entry that normal price fluctuations stop you out, but you also don't want it so far away that the loss becomes too big. A good place to set a stop loss is just below a recent support level or below the low of the entry candle pattern. For our bullish engulfing pattern, a logical stop loss would be just below the low of the big green engulfing candle. Let's add this crucial rule to our strategy. Our stop loss rule will be place an immediate stop loss order just below the low of the bullish engulfing candle. This makes perfect sense. The logic of our trade is that the bullish engulfing candle represents strong buying pressure. If the price falls back below the low of that candle, our initial reason for entering the trade is no longer valid. The buyers have failed to hold control. By selling at that point, we are admitting our hypothesis was wrong and moving on to the next opportunity with our capital mostly intact. Never, ever trade without a stop loss. Section 7. A sample strategy, the moving average crossover with RSI. Let's put all the pieces together into one complete simple trading strategy. It is important to have all your rules written down in one place. This makes them easy to follow and test. You can print this out and keep it on your desk when you are looking at charts. Having a physical checklist helps you stay disciplined and ensures you don't miss any of the steps. Remember, consistency is key. You must apply the rules in the exact same way every single time to know if the strategy actually works over the long run. Here is our complete sample strategy. Strategy name, the 50 SMA Bullish Engulfing Strategy. Asset type, works best on stocks or assets that tend to trend. Time frame, daily chart, entry rules, all three must be met. 1. Trend. The price must be trading above the 50-day simple moving average SMA. 2. Signal. A clear bullish engulfing candlestick pattern must form. 3. Momentum. The relative strength index, RSI, must be below 70 at the close of the engulfing candle. Exit rules. You will exit based on whichever happens first. 1. Profit target. Sell the position when the RSI crosses above 70. 2. Stop loss. Sell the position immediately if the price drops below the low of the bullish engulfing candle. This is a complete mechanical trading system. There is no room for interpretation or emotion. You have a rule for the trend, a rule for your entry signal, a confirmation rule, a profit-taking rule, and a loss-cutting rule. Each part has a specific logic behind it. The moving average ensures you are trading with the primary trend. The engulfing candle gives you a specific entry point based on buying pressure. The RSI helps you avoid chasing highs and provides a logical exit point. The stop loss protects your capital if the trade idea proves to be wrong. This strategy is designed to be a starting point. It is not a magical formula for getting rich quick. No such formula exists. Its purpose is to show you how the different components of a strategy fit together. It combines trend, price action, and momentum into a logical framework. It teaches you the importance of having rules for every part of the trade, from entry to exit. By understanding the logic behind this simple strategy, you will be better equipped to start developing and testing your own ideas and finding what works best for you and your trading style. Section 8. Backtesting your strategy. Traveling back in time. Now that you have a complete strategy written down, how do you know if it's any good? You certainly don't want to start trading it with real money right away. This is where backtesting comes in. Backtesting is the process of applying your strategy rules to historical price data to see how it would have performed in the past. TradingView has an amazing feature called the bar replay tool that lets you do this manually. It allows you to go back in time on any chart and then move forward one candle at a time. This is a powerful way to simulate real trading. To start backtesting, open a chart of a stock you are interested in, like Microsoft, MSFT, on the daily time frame. At the top of the chart, you will see a button that looks like a rewind icon. This is the bar replay tool. Click it, and then click on a point in the chart's past, perhaps a year or two ago. The chart will hide all the data to the right of that point. It's like you've traveled back in time. Now, you can press the play button to move the chart forward one candle at a time. This allows you to make trading decisions without knowing what is going to happen next, just like in real life. As you move the chart forward, candle by candle, you apply your strategy rules. Look for your entry setup. Is the price above the 50 SMA? Do you see a bullish engulfing pattern? Is the RSI below 70? If all the rules are met, you pause the replay and mark your entry on the chart. You also mark your stop loss level and your profit target condition. Then you continue to press play, moving forward one day at a time until one of your exit rules is triggered. You record the result of the trade. Was it a win or a loss, and by how much? Then you continue looking for the next setup. You should do this for at least 50 to 100 trades on a few different stocks. Keep a simple journal or spreadsheet to track your results. This process will give you a feel for how the strategy performs. You will see its winning streaks and its losing streaks. You will learn how often it trades and what the average win and average loss look like. This manual backtesting is invaluable because it forces you to practice recognizing your setup over and over again. It builds your confidence in the system and highlights any potential flaws you might need to address before you ever risk a single dollar. Section 9. Now it's your turn. Practice with paper trading. After you have backtested your strategy and feel comfortable with it, the next logical step is paper trading. Paper trading, also known as simulated trading, is where you practice your strategy in the live market but with fake money. TradingView offers a fantastic paper trading feature that is integrated directly into the platform. You can connect to it with one click and you'll be given a virtual account balance, for example, $100,000 in fake money. This allows you to place buy and sell orders in real time as if you were actually trading, but without any financial risk. Paper trading is the bridge between backtesting and real trading. Backtesting shows you how a strategy worked in the past, but paper trading tests how you execute that strategy in the present. The market is live, prices are moving, and you have to make decisions as signals appear. It helps you get used to the mechanics of placing orders, setting stop losses, and managing your positions in a live environment. It also forces you to deal with the psychological aspect of seeing your virtual account balance go up and down, which is a very different feeling from just looking at historical charts. To get started, simply go to the trading panel at the bottom of your TradingView chart and select paper trading. Once connected, you can start following your strategy. When you see your entry signal form on the chart, you can place a buy order. You can then immediately place your stop-loss order and monitor the trade until your profit-taking rule is hit. This practice is crucial. It helps you build the right habits and routines. It proves to yourself that you can follow your rules consistently and with discipline before your hard-earned money is on the line. I encourage you to take this final step very seriously. Spend at least a few months paper trading your strategy. The goal is not to make the most fake money possible. The goal is to execute your plan flawlessly. Can you follow your rules for 50 trades in a row without making an emotional mistake? If you can do that, you are building the foundation of a successful trader. Trading is a skill, and like any skill, it requires practice. By using tools like backtesting and paper trading, you are practicing safely and intelligently. You are learning to walk before you try to run, which is the smartest way to begin your trading journey.